Hello and welcome to this Wednesday edition of FreightWaves Now. I'm your host Anthony Smith, and coming up, Andrew Cox is going to give us a shipper update. But first, we're going to go to Zach Strickland with Carrier Update, brought to you by PowerFleet. Stay tuned.
Welcome to your Wednesday Carrier Update presented by PowerFleet. I'm Zach Strickland, and today I wanted to lead off with something a little bit different. I want to talk about our different carrier type ORs, operating ratios. So this is basically a measure of how effective a carrier's operating using the revenue that it's getting from its sales. So a 100 OR basically means they are breaking even on their operation. They get $100 to move a load, and they use that $100 to move that load all in. So they make no money whatsoever on the operation. You can see here that we have been hovering around that 100 mark for the last several months, ending in 2019. So looking at these ORs, you know, I've made a line right here about a 99 OR, because that's basically the bare minimum, even though that the operating ratio does measure, you know, profitability to an extent. It does not include things like debt servicing and whatnot. So there is going to be a little bit extra money that the carrier has to spend to keep in business. And normally that's around 1 to 2% extra outside of the operating ratio. So looking at the flatbed carrier here in orange, 103 OR in May, not great. Now this is Truckload Carriers Association data, and it's an average of all the carriers' operating ratios, and they have them broken down into flatbed, reefer, and dry van. 103 OR, flatbed is having a really bad time right now. We've got dry van here in the blue, the dry van carrier right around 100, and the reefer carrier here in May actually had about 100 OR as well. So again, not a great operating scenario for a lot of carriers. We know we've been seeing this rate suppression for a period of time. So hopefully here in the next little bit, as we are starting to see some of this market turn around. If you notice here though, in March, there's a big drop in OR, and that is a positive sign. They actually broke into profitability for all three modes during that period of time, at least for the TCA members. So again, we had a robust March. April was terrible, one of the worst ORs ever. But again, flatbed continues to struggle. Again, they have been exposed to a lot of that oil market, which has not been a great sector to operate in here in the last few months. So looking at our tender rejection rates. Now these do tend to correlate with how profitable carriers are. So tender rejection rates go up, ORs tend to go down. So again, a little bit of an inverse relationship there, but tender rejection rates starting to creep up. You know, not so much here in the flatbed side. So this green line is the flatbed carrier, the blue line is the dry van, and the purple line here is the reefer. And the reefer, of course, having some of the, you know, more of the tighter market conditions. And if you notice from the last chart we had, they were probably the most profitable on the TCA members. So dry van right in the middle, and flatbed down there at the bottom, again, the highest OR. So, but we are starting to see those things turn up a little bit. So where in the country can we see some of this activity turn up? Here we have our most volatile markets. El Paso showing up on the strong increase on the outbound tender volume index here in the last little bit. Albuquerque, New Mexico, Wilmington, lots of decent increases on volumes today. But you know, Wilmington, North Carolina showing a strong increase on head haul. Not a lot of activity on the tender rejection rate for a lot of these stronger volume increase markets. But I do want to kind of target a few of these areas. So we've got out here in the west and up there in the Midwest, Dubuque, Iowa, as well as El Paso. El Paso showing some strong volume increases right there. Outbound tender rejection rate also coming up for the El Paso market. So again, if you are operating out of El Paso, again, we have a lot of border crossing activity there. The automotive industry, of course, pulls a lot of freight through there. Starting to see a lot of pickup in activity on the El Paso border crossing. So anybody moving, anything coming out of there, it's a lot of long haul freight. If you break down the tender volumes, a lot of long haul freight coming out of El Paso. So be sure to pay attention to the El Paso market today, showing a strong increase on volume, as well as a decent increase on tender rejection rates. So Dubuque, Iowa, sitting up here in the middle of Iowa, or in the upper corner of Iowa, I should say, showing a little bit of a mixed signal here. You've got dry van volumes going up, while dry van rejection rates coming down, reefer volumes going down, while reefer rejection rates going up. So reefer carriers may have some activity on the spot market. Dry van is going to have activity on the contracted side. So reefer, the Dubuque market shown a little bit of a weird pattern to operate in today. And that'll do it for today's carrier update.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Welcome to your shipper update, and I'm excited to be here with Andrew Cox. Andrew, what do you have for us today?
Anthony, politically, the U.S. and China are barely on speaking terms, but if we look at it on the trade-wise, we're as thick as thieves. We're even thicker than we were pre-COVID. So I just wanted to look at some of the import data that we have and compare it to the Chinese, the total imports and the imports from China, and show that China's market share and their growth of the imports has actually increased pre-COVID. So this is the year-to-date chart. So in blue, we have total U.S. imports, and then in the green, we have U.S. imports from China. So you can see we're up 7% year-to-date on total imports, and China is up almost 50%. So you can see that that increase is significant. It's even more significant if we look at since the lockdowns began. So this goes back to middle of March. You can see that that total imports are up 32% and Chinese imports are up 245%. So with all of the talk from American businesses and from the U.S. government about trying to cut ties with China or trying to diversify away from Chinese production, we're just not seeing that right now, and it's not exactly a bad thing. These volumes, especially to the West Coast, have helped kind of prop up that volume drop and help demand on the West Coast so far.
Right, and when we look at the West Coast, that's a whole different commodity typically when we see on the East Coast. East Coast is a lot of industrial sector stuff. West Coast really talking to a lot of consumer commodities and things like that.
Yeah, I mean, if we look at Ontario, the inland capital with all the warehouses, that's a lot of retail goods, a lot of consumer goods just outside of the port of LA. Long Beach, same thing. These are two of the biggest ports in the country. There's a lot of consumer goods coming from China there. You know, we've seen this. We look at that Bank of America data, the online electronics consumer data has been ridiculous, up triple digits year over year. So there are things that are coming in from China, and that's why we're seeing this big import gain. But I just think this is a dangerous game to be playing when now we're hearing a lot of this talks that U.S. is going to be trying to flex their muscles again and get back into this trade war that probably never ended. And it's just it's a dangerous game to be playing when we're relying more on them now than we ever were.
Right, you mentioned dangerous game indeed, and when we're looking at this, the numbers are right here, right? So we can see that there's obviously a dependency on both sides, and so when we're looking at this, one of the things that really pops into my mind initially is that there is so much of an infrastructure that's already built in China, and it's really difficult to kind of find a substitute to kind of replace them, even if you're looking at nearshoring, as many has talked about, when looking at partnering with Mexico for a little bit more manufacturing, a little bit more partnerships there, but China is almost essentially seems to be set up perfectly for this type of relationship.
Yeah, you're precisely right, man. I mean, we look at for the last 50 years, or the last 30 years or so, China has been the production for the entire world, just about. You can look at some of the other Southeastern Asian countries like Vietnam to look at other places, but they just simply don't have the population, they don't have the infrastructure, they don't have the ports or the air cargo, the international airports that are there set up that China does. So it's just nobody else is set up like China. We're much more reliant on China than they are of us, I think, at this point. But if you want to, we can see that these rates. The point I wanted to bring this up is for the shippers. Like these are our Freightos Daily Baltic indexes for various lanes. The blue one is the China to U.S. West Coast, up 60% in the last 3 months. So if you're a shipper that bringing in goods or bringing in parts from China, go ahead and prepare yourself. You're going to be paying higher rates for the foreseeable future. We've had a little bit of a plateau here in the last few days, but rates are much higher than they were just a couple months ago.
Right, and shot in the dark here. I always like to ask you a question here, but when we're looking at this plateau, do you think this is going to be something that's sustainable at this high level in the coming months?
Well, the consumer demand is pretty high right now. Again, that Bank of America data, it's better than I would expect it. Total retail spending is only down in the single-digit range. I expect that data to even pick up a little bit more. We talked about that yesterday on our podcast with Seth. Again, I'm all looking towards that end of July date where the consumer money, some of this unemployment benefits are going to run out. I don't know if what the demand is going to be then, but until then, I do think that consumer demand will be pretty strong. So I think you're going to see increased rates here for the foreseeable future. They've stopped blanking sailing, so they've brought more ships online, but there is quite a bit of demand.
Excellent. Andrew, thank you so much. Insightful as always.
Yes,
and thank you so much for tuning in. That's going to do for the Shipper Update and this episode of FreightWaves Now. But the content doesn't stop here. You can check out all of our streaming media on all your favorite platforms, including Apple TV. Thank you so much for tuning in, and we'll see you on the next episode.